Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 9th of August here in 2022. Got three letters, CPI, the Consumer Price Index, and the rate of inflation. That's going to be on focus for Wednesday's session. But before we get there, let's talk a couple of things on the bigger picture and what that CPI data might do for the markets. Start first with the S&P. Still into this will it or won't it, or this much and no more, this high and no more upside action. That's against the 4,200, and in the SPX, that's roughly speaking the same level. Now, what happens if the market goes this much and then beyond? Well, that will open up a risk pathway, and that's how I will classify it, that there is risk above the 4,200, 4,211, just a little bit above where we are currently, and the reward will again be to the downside. That is playing a similar scenario to where we saw into March and April. That is what I'm watching, and that's what the play could be here on the CPI data. But again, before we get there, we'll have earnings tomorrow after the bell from Walt Disney. So let's start right there before we jump into CPI. Walt Disney, it's going to have its earnings taking place after the close tomorrow on Wednesday. And what are we looking for? What is the implied volatility? 95% with about, again, this is before the close, so we'll look at that closer. And if you want to put any butterfly trades on, this would be what to look at. That would be the $7.50 or a 95% implied volatility. Now where would that take the stock price? Potentially up to, looking at the $7, here's how to think about earnings-based volatility. So about 750 takes it to around 116 per share. We'll update this again tomorrow. And down 750 takes it to roughly 101. So these are the levels to watch for Disney on the earnings as they are released. And that's what we'll be watching as this downtrend continues. And it as well, Disney prices, Disney share prices as well, has its similar this much and no more. That's going to be where the play will take place into the future, at least from a swing trade perspective. But before we begin, on tomorrow's earnings, let's look at one stock in today's session. That's Emerson. And Emerson, in terms of where it played, similarly had its upper resistance point into about 92 per share. There's a key support level I have drawn, about 90. And the stock went down from that resistance point. Earnings again came in, and to watch the earnings on any particular share or any particular stock in the share price, that will be under fundamentals and then earnings. Whether or not they beat the estimate and what the straddle implied volatility and how the stock reacted. That's usually what we look for on the earnings play. And that was a down move. In the Nasdaq, the down move is taking place just shy of the 13,500. So again, in my world, I like to look at the similar things and possible outcomes, and therefore similar trades. And that would be bearish against these resistance levels with the same logic in play that there is risk to the upside. I say that because the market had a stellar multi-day rally, and to assume that rally just continues, in other words, about 15 or so days in a row just about to the upside, it is a little lower probability to have the 16th, 17th, 18th day be additional upside. Much, much, much more favorable odds to see a down reversal. That will be in play again here. A little bit lower probability, I'd say quite a bit more probability to the downside than additional bullish price action. That probability does not mean certainty, and even low probability outcomes in the market can occur. And that does, again, how I like to structure this, risk and hedges and protection and stop losses and anything along that line would be to the upside, but reward and profit and probability would be to the downside. And that will be true also in the Dow mini futures into the 13 or 33,000 index level, and in the small cap Russell index, falling shy right here of the 2,000 on the index. That'll be about the 200-day simple moving average. before we get into CPI, again, the bond market, downtrending, had a stellar rally and continues to have this rally into the TLT price of 120. That will be something we're watching closely. A fall to the downside takes it back to 110 per share. That would be true in ZN, which also crested above its upper resistance, and ZB. So now we can talk about the CPI data. A couple of things to watch. This will occur pre-market, so 1 hour before the market opens on Wednesday, we'll know what the CPI data, how they report. So a quick look at this shows, I think, all about the 8.7% or 9.1%. That's an annualized or year-over-year value. What might it be? This is the month by month. Last month, 1.3%, and expected this month, about 1.2%. Taking out the energy and food, right? Month over month, taking out energy. In other words, oil or energy prices, and food, commodity prices, and how the grocery store and all the things that are showing inflation, take that out. That's a little more stable to look at things not food and energy. Previous was 0.7% month over month. Currently expectation 0.5. So year over year, 5.9. A little bit of an expectation to come in hotter than expected. Hotter than expected means higher inflation. What might this do to markets? Two scenarios. Scenario one, lower. And that's inflation, or the rate of inflation, month over month and year over year inflation. That is forefront in the Fed's mind, Federal Reserve, and most of us here at TheoTrade and in the general investing and trading community. Inflation. Is it ramping up or going down? If inflation is lower, so it comes in under expectations, that could be a good sign for equity futures. Could be a good sign. And if inflation is lower, that means the Fed does not have to step forward and step more aggressively to raise the rates. So a lower inflation number could be bullish for equities. Well, let's go one step further. And if the rate of inflation is higher, comes in higher than expected, that could be bearish. And it could be bearish potentially in a big way for the equity market. What about the bond market? Lower inflation number. That means the Fed does not have to be as aggressive with the rates. So if rates are not going to be on a stellar upside pathway, that actually would be bullish for the bond market. Rates higher than expected, or at least the inflation numbers higher than expected. For the bond market, that would be, at least for the prices, if rates go up, that means that the bond prices could go down. Now that would be something we're going to keep a close watch on, not to mention the dollar and how the impact affects individual sectors. For example, higher interest rates could be bullish for the financials, very bearish for technology. So what might this be? We can keep it simple. On TNX, TNX is the 10-year Treasury note yield. We can look at the 2-year or lower, or we can look at the bonds in the 30-year. All eyes are going to be at this 30, which is 3%. 3% of the interest rate on the 10-year Treasury note. If inflation numbers come in hotter than expected, it means the Fed could be more aggressive, and that would be just about guaranteed for a 75 basis point, 0.75, 75 basis points. Maybe we'll see another discussion on a 1% rise. Not in the cards just yet, but 0.75 versus 0.50, that could be a big difference in the upcoming next month Fed meeting. So if it comes in lower than, hotter than expected, higher than expected, bigger inflation, that could be bullish for the bond yield, and by proxy, bearish for bond prices. Bearish for bond prices. We can also talk about the US dollar. These are things you'll be looking at, watching, and carefully considering. Again, if inflation numbers could be hotter than expected, higher interest rates quicker could be a support or a rally base in the dollar index. Now that could send commodities lower. We'll see. We'll all see this. But this is how I'm framing, or at least looking at it from the bigger perspective, and how the number comes in, higher or lower, or potentially I actually haven't thought about that. Well, what if it comes in directly at expectation, and then we'll see the markets react to that. But generally, it's either going to be higher or hotter or faster than expected, or perhaps lower, and the markets across the board will react. So that's what we'll be watching in tomorrow's session and beyond the rest of this week and into next week. So that is the big picture and inflation data, again, right there forefront on our discussion. We'll take a look later in the week, in next Thursday's video, and some of the key stocks and key stocks making 52-week highs, 52-week lows, which stocks continue their uptrend or downtrend, and what again are setups or plays or opportunities for the broader market. But just to give a hint, most of the opportunities on the tech sector, that's Apple, which has a similar downside bias. We'll take a look at Google, again at the top of its trading range with a downside bias. Perhaps Amazon at the top of its range with a downside bias, and some other stocks that you might want to look at from the tech sector and beyond. But for now, we're going to look at the CPI data before the market opens on Wednesday and have our positions in, or if not, position after, hedge, protect, be defensive, or be a little more aggressive if the play is in the direction of your current trades or current outlook on the market, which would probably be or possibly be to the downside. As always, be careful and safe. This is Corey Rosenblum with tonight's video of update for TheoTrade here on the 9th of August in 2022.